guys doing? Hope you guys are having a fantastic day. Today we're learning about fair value gaps. There's 4 variations of this. I know there's a couple more, but these are just super basic ones that are essential for your entry points. And the entry points are basically the retracements that you want to see after the change in state of delivery. So we have a first we have a normal fair value gap. There are 2 variations of this. There is a busy. I'll show you guys on the charts. I'm gonna draw it out just so it's super straightforward. Let's do that. There we go. This is a busy, buy side imbalance, sell side inefficiency. So when you guys mark this out on your charts, put this over it or in the box yourself. I don't do that anymore usually. Make the box green because it's a bullish one. It's inefficient in sell side delivery. So what you usually see with these is price want to retreat back down into it like this. And if price stays above the consequent encroachment, which is the midpoint of it, the midpoint of this candle's low, the candlestick's high, the midpoint is the consequent encroachment. If we can stay above it, then you can see a strong push higher. None to say the less. If we fully fill it, then we can still see a massive pump higher. All we're saying is that if we stay above the consequent encroachment, the chances of us getting a massive push higher is more probable. So definitely keep that in mind. Let me just frame out now, like, what is a fair value gap. I'm just gonna draw the other version too, so you guys have both versions and you're not getting confused at all. Alright, there we go, guys. So make it super clear. We'll start off with the buy side imbalance, sell side inefficiency. So it's sell side inefficient, which means that this is cleared out the buy side orders, and we are sell side inefficiency, meaning the sell orders have not been triggered. So what you want to see in price, the price is up here, right, guys? This is the live price, pretend. This is the live price because this is where price is currently forming. So this is the close, and what you would expect is if we took sell side out here, sell side taken, change in state was here, you would expect price to come down in here, and that's where you would buy at this candlestick's low, targeting a form of buy side. So a fair value gap consists of, in terms of this fair value gap, it's a busy. It consists of 3 candlesticks. Same with the SIBI, 3 candlesticks. We have the lower one, which is the high of the wick, and that'll usually be the low of the busy. We have the second candlestick, which is usually the displacement leg, and you will have the third candlestick, which is usually the low of the candlestick will be the high of the busy. So if you see like a gap like this, the first candlestick's wick and the second candlestick's wick, as you guys can see, there's like a gap here, and it's just body of it's just the second candlestick's body. Then yeah, that is a fair value gap right there. And we'll go over examples too in the charts so you guys aren't confused. But whenever there's no overlapping wicks here, that's considered a buy side imbalance, sell side inefficiency. Sell side inefficient meaning when price is up here, we're expecting price to come down in here, and this is where we buy. So now let's go over to the SIBI. So what SIBI stands for, sell side imbalance. Sell side imbalance, right? Because they're bread candles to the downside. Buy side inefficiency, meaning we're missing buy orders to get filled. So you have to go up, buy side imbalance, cancel out the buy side inefficiency because buy side inefficient. Then you go down. So fill the orders, go down. So the candles, it's consisted of the same thing. 3 candlesticks, it's just to the downside. The same exact thing that I explained here, but it's just to the downside. So the first candlestick here to the left, the candlestick's low will usually be the high. Well, the candlestick's low will be the high. The second candlestick, it will usually be the displacement leg. So the body will usually be biggest. The third candlestick, the high of it will be the low of the sell side imbalance, buy side inefficiency. So the fair value gap, right? And we'll draw that out. Super simple. Again, the fair value gap is when I say fair value gap, it's this. It's both of these, the BISI and the CIBI. It's just more a overall term, more of a broader term, I guess you could say. This is buy side imbalance, sell side efficiency is essentially this one, and the sell side imbalance, buy side inefficiency is this one here. The fair value gap is both of these, you know. So it's just the gap in price, essentially. And this is being more specific when you refer to the gaps as these names up here. So yeah, let's put this in red. So if this is the live price, you'd expect price to return back into there. If we took out some sort of buy side liquidity and we got a change in state of delivery, then you could expect us to want to retrade into this area and see some sort of resistance and trade lower into some sell side. Yeah, so it's the low and the high of the third candlestick, right? So it's fairly simple. As you see, there's no overlapping of wicks in here, so that's where it is. And we'll go into the charts, but first, there are more gaps, guys, to this. There are the inversion, which means something like this. So if you take this, do something like this. This is the inversion aspect. So keep this drawn out. This is the inversion aspect of things. So when we invert it, so basically, essentially, we're expecting this to act as, depending on the narrative, of course, but usually we'd expect this to hold as resistance. Since we broke above it, you'd expect price to come down and then use it as support to then target some sort of buy side. Okay, so that's basically the inversion fair value gap. There's really nothing else I have to go over about it except for like the narrative standpoints of like when you know a CIBI or a BISI is gonna get broken to the upside or downside, and the same thing goes for the other one too. There's also an inversion aspect of it. This first, it is a BISI until it gets ran through, and then if there's some sort of sell side that plays in with the narrative of the overall price action and order flow, then you could expect us to hold this as resistance to then target that form of sell side, right? Yeah, we'll see that in today's chart review. But we also have a couple more gaps here. So we have breakaway gap as well. Here, I'll keep an example of the inversion up here, just so you guys don't get confused. So yeah, inversion like that. Got the CIBI, right guys, going down. BISI going up, it's just this one got broken through. So I'll keep this all up here, so if you guys want to take screenshots, go right ahead. So let's draw out the breakaway gap. Essentially, this is, I can just do it off of these ones actually. This is so, actually. Okay. So yeah, breakaway gaps are fairly more advanced, so I'm not expecting you guys to understand it right away, because you guys probably won't, because there's the only way you understand breakaway gaps is if there's a narrative standpoint behind it. There's no other way to use for breakaway gaps. You don't take trades off. Yeah, like you don't really use breakaway gaps like to do anything with, except to like move your stop loss up under and like expect it to stay open. Like that's all it is a fair value gap that stays open. It's just an indication of bullishness. That's all it is. So yeah, it doesn't get filled at all. It doesn't even get touched. It's just an indication of bullishness and continuation of strength in the direction that it's a confirmation that you're on the right side of price action and order flow. So what you would see is price wouldn't come down and it would just keep going. Usually this happens when there's a liquidity zone right above it, so it usually wouldn't even touch fill orders here. It would just snatch these orders really quick. Same for this downside example. And then you would want to see, does it even come back down into this, or do we keep going past the liquidity zone? And that would determine how strong the market is. If you want to stay in the trade, or if you're looking for longs or shorts, whatever it is. But I really don't think we should be getting into that right now, because I don't want you guys to get confused. So that's all I have to say about breakaway gaps. You don't really like need it to trade. It's just like, if you want to perfect your edge, you would definitely like get to know this stuff, because it's like a scale of how, it's like a telltale sign of how strong the market is to the upside or the downside. The next gap is a volume imbalance. So this one's super simple. So yeah, next thing is a volume imbalance, guys. So usually you would use this, well, I don't actually use this, but if you want to use volume imbalances, if you're looking to take more trades or whatever it is, taking more trades isn't necessarily like a good thing too, guys. So don't use it because of that. Use it because this is an entry point you want to perfect, right? So usually you would use this is if there is no fair value gap, and you have good not trust in this. You have like you see a good trade, like a good setup playing out right now, and the narrative is on point. You would see a gap between the bodies. That's how simple it is, guys. It's literally just a gap between the bodies. Usually price would retrace to it. So the candlestick, for example, like 2's high of the body, and which is the close, and the open of candlesticks 3, the low of its body, right? And usually you would expect price to come down into it, hold as support, and go higher, right? Same to the downside. If there's like, no, don't get me wrong, there could still be a fair value gap here, and you just take the trade based off of this and not the fair value gap. So it's whatever you prefer. They're both gaps, so they both act as a magnet. They both act as a inefficiency in price. So whether you want to take a trade in here or in the fair value gap, it's really the same thing. It's just, if you want to make sure you get in the trade, then take it in the higher one. If you want to get a better risk to reward ratio, wait for this low to get taken out and enter in the imbalance, right? So whichever one you choose, choose whichever one works better for you, and build a model out of it, right? So for the volume balance to the downside, for example, we'll pretend that there is a fair value up there, so it's literally simple as that. Boom. There we go. Volume imbalance right there. Wait for price to trigger right back into that and go short. That's how simple it is, guys. So definitely take a screenshot of that. We'll do, the inversions aren't even there, but definitely take a screenshot of this, guys. Inversions are literally just when price breaks through one of these, holds it, and goes in the opposite direction of the inefficiency, right? Super simple, super simple, especially when I show you guys in the charts. Alright guys, yeah, so take a photo of this, a little screenshot, and do some reviewing on it, and check it out in your charts to do some back testing. Yeah, so let's do some charting here. So we'll start off with the city and the BISI. So BISI is the one that's with green candlesticks. Right here we have a massive one at 1253. Write that out right here. So as you can see, chopped around, big displacement leg up. We have a high here, formed the BISI, price came down into it, and we just traded up to the high, right guys? And we have a gap right there, but we won't talk about that yet. To go this high right there. This is a BISI made out of bullish candlesticks. For me, it's green candlesticks. And if you want a civvy, is this one made out of black candlesticks, which is a bearish example of a fair value gap, right? So price came back into it and just immediately dumped after it. Another example right here, we have a bullish one that actually broke to the downside and turned into an inversion right there that targeted this low. I'll mark out a bunch of CBs here for multiple examples. CB there. There, slightly came into it. There, didn't even come into it, just dropped in. When that happens, and we take out this low and it just keeps on going and takes out this low again, you know it's gonna drop really quick because there was no price movement to the upside that wanted to fill any buy orders, so they're gonna leave the buy orders once they start taking like multiple lows to just absolutely dump price right there. That's a bullish one, busy. So yeah, guys, when this a busy is consistent of 3 green candlesticks, but actually it's not just 3 green ones. It could be, this one could be a black one, and then this one could be this. The middle one has to be green. That's the whole point of this. The middle one has to be green. For the bearish version, the middle one has to be black, right? Hopefully you guys are understanding. This is fairly simple. I don't know if I'm explaining it good, but it's fairly simple. So hopefully I go over it enough here and you guys see examples of yourself. You like see multiple examples of them here and you guys understand it. But yeah, let's go over the inversions now. So we went over the BISI and the CIBI. Let's go over the inversion aspects of it. Let's go up a time frame just so it's cleaner. So right here, look at the body's holding. We have an inversion, bullish, that broke to the downside, came back up, smashed lower. Let's do a bearish one. So kept holding it as resistance, came above it with strength, also taking out this high, came back down into it, holding the low, body's above the consequent encroachment, displacing higher, targeting highs. Again, another one to the upside, broke to the upside, holding as support, and we are gone. This looks like a nice clean entry model during the London session. So we took out, for example, just for a little execution example, we took out a low here, external liquidity, because it's not the same leg as this one, so it's external. We have an internal right here because it's the same leg. Boom. Change in state right there. This last open candle, black candle, right? Little internal sweep right there. Break above. Right there. Enter your long. Stop at the low. You could also put it at this low as well. It's really not too big of a difference. Target buy side. And what's above this buy side? This inefficiency. So that's a pretty high probability target, and that's it. You're done with that trade. Yeah, that's pretty much it for the inversions, guys. I really want you guys to practice this on your own. That's the only way you're gonna like benefit from it the most, is if you practice it. I taught you the basics from it. I showed you a couple of charting examples, and now it's really your turn to go into the charts and practice it yourself and backtest how price reacts off of these levels and prices, right? But now we'll go to the breakaway gaps. For example, this would be a breakaway gap right here. That one. And that one. Why are these breakaway gaps? Well, because there is a low here that is getting targeted since we took out these highs. Balance filled to the T right there. Boom. So I'm expecting this low to get taken out, and since we're so close to it, you want to see these imbalances stay open, and we just completely smash this low and obviously go a lot lower. So that's an example of a bearish scenario. I'll give you guys one more of those. So for example, this is an example of a breakaway gap that I would expect to get filled, because this is a breakaway gap until we take out this low. And then since we're bullish on a higher time frame, you can expect us to trade back into it, and that's a telltale sign that we are bullish and we have reverted from bearishness to bullishness. And there's a change in state there. Boom, come back into this fair value gap here, this BISI right there, and you could take a little position off of that, trades into it twice, and you could take a long, targeting these highs and this high here too, which it does get met. So that's just an example of a breakaway gap acting as a narrative standpoint to where price wants to go, how it got broken through, and traded back into as an inversion fair value gap to then target buy side liquidity. I know this might be a bit advanced and you guys might be getting confused, but it'll all make sense when you guys start back testing it and practicing on your own and seeing how price reacts to these price levels. So let's see a bullish example of this. There'll be a lot more of this because we are in a bullish market. This is another fair value gap that is a breakaway gap. Since there's a high that's so close, see a breakaway without even returning back into it. We took out the high, returned back into it, and we ended up holding the upper portion of the fair value gap, indicating that we were still bullish. And check it out, we just kept running up higher. This is a breakaway gap too. Barely touched the high. Yeah, honestly, guys, don't like dig in too much into the breakaway gaps. It's really just for a perspective on where price is heading in a more advanced level. It's really not something that you're going to be taking trades off of, you know. Let's do the volume balance. Volume balance is super simple, guys. Yeah, you guys are probably thinking like, what do we use these gaps for? Well, they're entry zones, except for the breakaway gap. Like these are entry zones, basically in the city, and the volume imbalances, and also inversion fair value gaps. They're targets, not the inversions, but all of these are targets, and they're confirmation zones, which they are all confirmation zones to see how price reacts to these price points. Let's definitely, yeah. So volume imbalances right away. What I see right here is a clear example of a bearish volume imbalance. So right there, that's where you would enter, and the price sells off. For a bullish example, right here, took out this low at 2:28. We took out 2:11 a.m.'s low. We have a volume imbalance here. We don't even get the change in state, so you wouldn't take this, but it's just a little example of how volume imbalances work. They usually want to get filled, and we will usually displace strongly away from them when they do get filled like this. As you can see, we probably didn't spend that much time in it. I didn't see how the candlestick formed in it, but I'm assuming that we touched it, came a bit below it to fill this fair value gap, and then we left it pretty quickly. See any more? As you can see here, sometimes it'll go way below the volume imbalance and just take out the low 2, come back up, and then we'll just volume imbalance in here. So you guys can take a trade based off of this one. As you can see, it holds quite nicely too. These lows here, get trade off that, go long, but of course it's like at a random time, so watch out with that. I was gonna say check out this, but it does not touch. It goes into the fair value gap instead. It comes back into the fair value gap here, also taking out this high, and then targeting these lows right here. The bodies hold it quite nicely, and we trade below this low, so you can take a trade there. Boom. The reason why I wouldn't take a trade there is because we're already so much into discount, and we're also still in a bullish uptrend, so it's like the risk is really not worth it. Of course, it's a nice trade, but I would not have taken that. Usually you'll see these volume imbalances with a lot of displacement to the upside. Why wouldn't you take this one over this one? Is because this one's such in a premium of this leg. It's literally at the high when this one is in a discount, so you take it at the discount. So you mark out a Fibonacci retracement, and this is the 50% mark. Below it, you want to take your trade in, so you can take it in the fair value up here or the volume imbalance. in this case, the fair value gap is a worse entry for your risk to reward, but regardless, decent trade for both, and you just take it in the volume bounce. It would be a even better entry to then target these highs right here. I'll show you guys one more bearish example. Didn't get filled there, we just dropped right off, but we did fill it here. We have one right there. Didn't even come back into the fair value gap, indicating insane bearish strength, but came back into the volume imbalance right there, sold off insanely quick. Yeah, that's pretty much it for this one, guys. Just talking about these gaps and explaining where they are on the charts. There's a couple misconceptions of these gaps. So treating like every gap as a tradable gap is definitely not something you want to do. As I showed you guys on the charts, that when the fair value gap is in a premium or a discount, you will see how some won't get respected and some will. Because if you're going long, you don't want to go long in a premium price. You want to go long in a discount. And if we're going short, selling the market, you want to go short in a premium, not a discount, because discount, it could easily get bought up depending on where we are in the whole higher time frame narrative as well. That all also comes into play. Ignoring time of day also comes into play, because it comes into play with the narrative standpoint of things and which fair value gaps will hold or not. Using imbalances as an entry without displacement, or MSS, which is a market structure shift, which is what I use, is a change in state of delivery. There's none of that, and then the fair value gap itself without the draw as well is also a lower probability trade, and you should probably not take it if it's not cleared. So if there's no draw on liquidity, no sweep of liquidity, and there's no market structure shift, then don't look to take this trade, or you're just gambling, right, guys? So there has to be a narrative standpoint behind it, there has to be a setup behind it, and there has to be a draw behind it. And yeah, also not like aligning these fair value gaps and these gaps, which, well, all these imbalances with a higher time frame narrative. So if we're bearish on a higher time frame and you're trying to go long off of a fair value gap, the chances are of that playing out are not as probable if you're trying to go short off of a SIBI, right? So all of this comes in together in a probabilistic format, and just putting all multiple confluences together, you'll get a higher probability fair value gap, and that's the type of trading you guys want to be doing, is putting multiple confluences together to get a higher probability BISI, SIBI, or inversion, or break volume balance. Breakaway gaps, you don't take trades off that, guys, right? Remember that. Yeah, that's pretty much it to this video, guys. I know it's a bit of a longer one, but definitely, if I missed something, comment down below and let me know, because it is pretty late at night, so I'm pretty tired. But yeah, definitely let me know. Let me know if I missed anything, and I'll answer you, and hopefully we could cover. I could help you guys out and cover everything in the comment section, or maybe make another video about it if it's reasonable. Yeah, the next video, guys, we have order blocks, which I will cover like briefly. I don't want to like cover it too much because I don't use it, but sometimes I use it as like confirmation. So yeah, guys, next video, order blocks, and yeah, I'm out. Peace.